Hello, I'm Alex Ortolani, Senior Reporter for Wealth Management, and I'm here with Alex Morris, CEO of FM Investments. Alex, thanks for joining us.
Thanks for having me. What a beautiful conference.
Thank you so much. Yeah, no, we appreciate it. So first question I have for you is, what portfolio challenges are advisors struggling with most in today's rate and market environment?
Well, there's a lot of challenges. The ones that we really focus on have to do with, are we looking at real rates, which is like what actually happens in your portfolio, net of inflation, net of all of life's unavoidable costs and taxes, versus what is a really incredible headline number? And it's really hard, I think, as an advisor to make clients focus on what they're really taking home at the end of the day, as opposed to chasing constant returns. It doesn't sound all that sexy to buy a 3% T-bill, but that, or say 3% plus some inflation protection, which sounds even less sexy. But at the end of the day, they ask for cash and they want to know, why am I selling a third of my portfolio to achieve whatever my financial outcome was? And the answer is, well, it looked great at the time, but net of taxes, net of the real economy, things didn't work. And I think advisors have a really great job to do in explaining to folks why maybe you shouldn't go chasing every IPO and why some of the hot dots out there don't work as well as they might think.
Yeah, very good. And that's really where the advisor brings their value, right?
A lot
to
of
be
value.
able to do that.
I mean, it's where we have conversations with advisors. I'm amazed at how good they are at explaining problems that we see in ways that are unique and different to the clientele they have.
Well, I think sort of on this area, where do you see right now the biggest gaps in ETF and mutual fund landscapes, and again, for advisors to solve real world needs for their clients?
So there's an interesting gap just in your question between mutual funds and ETFs themselves. And we've done some bridging of that by dual share class that got a lot of popular appeal in trade rags, but we think clients are going to start hearing more and more about. You have a legacy mutual fund position, hey, maybe I can find a way to convert that to an ETF, which has some other trading benefits to it. But from a product standpoint, mutual fund world has been pretty stoic. It has the usual 60-40 things, and the costs are often lamented, and the tax treatment isn't great. And ETFs have gone off in a completely different direction, right? High levels of innovation, highly reactive to what the market wants. I think we're seeing, if we just look at number of new products come to the market, there are obviously some levered and inverse ETFs, and I think those are mostly retail traders. I don't think advisors are buying that for 30 years, and they probably shouldn't for their clients. But a lot of the levered products that gave way to buffered ETFs, defined outcome ETFs, some of the precision items that we are and others offer, really point to advisors have a great job to do, and they need this tool set to help achieve really one of two things. Classic portfolio implementation in a better way, free of noise, and then defined outcomes to take some percentage of the portfolio and provide an outcome that a client has asked you for with some certainty. Otherwise, spend a lot of time chasing that, and no one wants to sit down 4 times a year and say, great news, we told you it was going to do this, and it did exactly not that.
Well, very good. Well, you mentioned all the different types of ETFs coming to market, a lot of innovation. But I think there's also maybe an education element for some advisors and seeing what exactly they need. Where are you seeing advisors give uptake to some of these newer ETF products?
Certainly the buffered ETF space has been really attractive. We see a lot of folks also going back to basics, some of the more plain vanilla tools that we've offered. But this sort of innovation bend has really been made possible by a change of regulation and a rereading of some of the rules by the SEC a few years ago, which is great. And that came in. A lot of equity products came out as a result. We're now seeing that move into options. We're going to see it come into fixed income. We see elements into private credit, which are interesting. But the sort of good reminder is, evolution's a messy process. It takes a long time to work. Somehow the Tyrannosaurus Rex died and the platypus won that battle. Go figure. So I think there's going to be a lot of things that are tried.
Yeah.
Let's talk in 5 years and see what stuck around. I think the ones that are going to work are the ones that really have a simple mission that we could describe in 30 seconds to each other, and you could say, I understand how I would use that. If you have to cock your head 30 degrees to the right, squint a few times and say, okay, how would I make this work? Probably a good sign that that's not going to be a mainstay of a portfolio for very long.
Got it. No, I love that. And I love the dinosaur references, but when you think about, I guess, some of the areas that you still see for potential for different innovations, where are some areas, you think maybe advisors wish they could do something different, and what would you say to them now about,
I think advisors like precision, so they want to know that I'm going to buy something that's going to do just that. And we sell a lot of products that are they're dull white paint. And our goal is to just do what it says on the tin. Never do anything exciting. I think we'll see more of that. I think advisors want that because they don't want to think about all of the other risks. Let's just get rid of them and honestly get rid of them. I think advisors are also going to like things that have better tax outcomes, things that are more thoughtful about how do we reduce portfolio churn. Even though it's often no commission trading, clients really want to know you've put them in a set of products that are helping to deliver that outcome, and not that you're running around trying to always keep the plate spinning. And so we'll see more work in the tax space, particularly as more taxable investors have more taxable wealth. I think we'll see more in precision. I think we'll also see a lot more in that sort of combination of defined outcome, less in the option space though, but just more in understanding as the equity market changes, as we go much tech heavier, as we sort of wonder when does the bubble burst, not so much if, but when, how do we react at that moment? And there'll be a whole slew of products after that that offer downside protection, which I think will be interesting, but it's too late at that point. So now, well, how do we get you positioned where you worry less about it in the future? Not because we don't want to engage with each other, but rather you just don't want to have to worry.
Yeah, no, that's great. Yeah, that de-risking, and also as you said, the tax questions and trying to bring that advisor value by talking to clients.
I mean, look, I don't think anyone looks forward to April 15th as like the best day of the year for them. So
no.
Anything you can do to make that a smaller burden, less worrisome, and realistically, just less of a surprise.
Yeah, definitely.
Much better.
Very good. Well, Alex, thank you so much. Appreciate you being here. All right, and thanks for listening.